Let's welcome on board Laurence Balanco, technical analyst at CLSA, joining in on the show right now. Laurence, hi, good morning. Great to have you on the show. Help us understand what your prognosis right now for the US equity markets is. As I understand, you're foreseeing a 10% fall. Is that right?
Yeah, we've been highlighting the fact that the markets become more concentrated. So all our breadth indicators are very narrow. And that kind of narrowing typically happens towards the end of a move rather than the start of a new breakout campaign. And then the second factor is, this is the start of the worst 3-month holding period for equity. So seasonally, we typically see weak markets basically running from July through to September. And then in addition to that, last night's price action, we saw the Nasdaq break below its 20-day moving average. We're sitting right on the 50-day moving average for the S&P. And we do think we break below those areas and fall back to the 200-day moving average. And that's roughly the 10% guide that we think this weak seasonal period has in store for us.
Sure. Just wanted to understand the nature of this fall, Laurence. Is it going to be one steep, sharp drop as we saw early 2020 when the pandemic broke, or is it going to be a more slow, grinding one in nature?
Well, we think it's more of a correction rather than a significant fall as we saw in early 2020. So we think it's more of the grinding variety and the duration typically, like I say, is over a 2-month period towards September, where we think that will be the next risk-reward buying opportunity for equity markets at the end of the day. So we don't think this is set up for a major decline as you saw in the start of 2020, but it's a correction within this longer-term uptrend, and it's a test of the rising 200-day moving average, essentially.
Laurence, what could challenge your call of markets coming down? Because typically when bond yields, they come down, equities, they go higher. And in this case, if the tech names, US tech companies, Facebook, Amazon, Microsoft, if they come back, could that really arrest the fall?
Well, I think if you look at last night's action, you had yields gapping down below its 200-day moving average, and you still had the Nasdaq falling over 1%. While it outperformed in relative terms as it fell less, it still fell in absolute terms. And both the tech side, growth side, as well as the cyclical value side falling gets an index correcting in absolute terms. And that's where we get the magnitude, where not only does growth correct, but you've had already cyclical stocks correct 10% and would likely remain under pressure through this corrective period. I mean, in addition to the fall in equities, we saw the Asian currency indices break down, and typically weak Asian currencies have seen the equity markets underperform. And if you look at Brent, we also broke below 71.40, and equities and Brent have also gone hand in hand since the March 2020 lows. So I think the fact that we've seen not only one equity market roll over, but a handful of markets line up in unison sort of increases the probability that we still have further downside risk to run over the next 2 to 3 months.
Laurence, what to your mind will prompt you to say that this market will go into not a 10% correction, which is your current view, but a bear market has started? Do you think a bear market has started, or this could be a sharp and a savage bull market correction?
So our base case is that this is a correction in an ongoing bull market rather than the start of a more significant bear market type scenario. To get that scenario unfolding, we'd have to see our credit spread indicators widen above the current levels that we've seen. If you look at emerging market credit spreads, or if you look at US credit spreads, they're still at narrow levels, and they typically widen before we get declines of 20+%. And in addition to that, we need to see the price action lineup that we've actually got a major topping pattern in place. If you focus in on the nifty, basically for the month of June, we've been in a very narrow range of 15,500 basically to 16,000. So breaking down from that, that gives you 500 points off the market back to 15,000 at least. So we don't have any major topping pattern in place that can get us declines of 20+% at the various indices that we're tracking.
So Lawrence, if I have to request you to perhaps talk about a level 3 months out and 6 months out, where do you think S&P is headed and where do you think Nifty is headed?
So if we look at the S&P, we think the downside correction within the next 3 months would see the S&P trade back towards the 3,950 area to 4,030 zone. So that's where we think the downside risk is on a 3-month basis. On a 6-month basis, we think the market will be trading up towards 4,500 to 4,600. Now, if we overlay that on the Nifty, we think the downside risk over the next 3 months is back towards 14,500 for the Nifty. And then looking on a 6-month basis, we think we'll be closer to the 16,500 to 17,000 area. Those are the parameters that we'd look for on a 3 to 6 month basis for the two markets.
Laurence, when it comes to the Indian context, is it going to be a more across-the-board fall, replicating the U.S. markets, or would you say there is going to be, or there are one or two odd sectors which are looking weaker in the entire gamut and could drag the markets further?
Well, I think let's start off on at least the relative outperformers. And there's no real surprise when we look at what we expect to outperform in relative terms over the next 3 months. If you look at the NSE Farmer Index, the absolute chart's still above the 50-day moving average. The relative chart is now making new 3-month relative highs. So we think we'll get outperformance from the pharma sector as well as the FMCG sector. So here in absolute terms, we're holding above the 50-day moving average. And the relative chart, after underperforming since June 2020, is now starting to hook up and give you outperformance. So those are typical defensive sectors, which we think over the next 3 months, you would at least hold your value in a market correction. But once that's run its course, we think, again, what would lead the Nifty towards that 17,000 target is the NSE Banks Index breaking above the 37,500 area. So essentially, NSE banks have been capped or have peaked in February, and since then have been in a consolidation pattern, trading in a sideways range since then. And to have the Nifty trading back to 17,000, we think this is a key sector that will drive it to the upside. So the point here is, into August, September, the NSE Banks Index closer to the 31,000 area. I think that's the area that you accumulate banks for the ultimate move into 2022.
Sure. Talking about the underperformers, though, and one space which is held out, and unfortunate as it may be, is globally linked. What about commodities per se? Would you say that the super cycle is now coming to a close? Are we headed in for a steeper correction, for instance, for metals?
So, if you look at copper, we've already had a correction, and we're starting to find support just above the $4 area. If you look at the CMEX contract, if you look at aluminium nickel, that's actually broken higher recently. So we're getting a good trend from the nickel side. And if you look at alumina, that's consolidating around the 2,500 area. So, like equities and broader risk, we think for the commodities side, this is more of a correction and consolidation pattern, and would expect another leg to the upside. But clearly in the near term, there is downside risk of further weakness looking at the broader metals space, particularly from the equity side. If you look at the NSE metal index, you basically have failed to get above the 5,600 area, and we think there's at least downside risk back towards the 4,800 to 4,500 area.
Laurence, it's interesting that you say that banks hold the key for the markets to move up higher and perhaps test 17K as well. Within banks, what one is seeing is divergence. The erstwhile leaders like the HDFC PAC is clearly taking a back seat. You are seeing some of the state-owned PSU banks which are taking leadership. And within banks as well, you're seeing this big shuffle take place. What are your own thoughts on where within banks do you actually find leadership and what's going to continue to remain at the back foot?
Well, I'll comment on the index level, and you can take the biggest weighting within that, and that's pretty much the standout. But if you look at the state banks, the index has essentially done nothing for a decade, and recently we broke out of that consolidation pattern, and I think that's going to be the key lead gain into 2022 is coming from the state banks. That's where we're getting the biggest breakout. That's not to say that we're not going to get the private banks performing, but I definitely think from a decade-long period of underperformance versus the market and versus the private banks, is that the state banks I would expect to lead the broader banks index higher, and that driving the market towards that 17,000 area.
Laurence, pleasure having you on board. Thanks much for joining in and sharing with us your outlook on the markets.